Hi, Ellie. Welcome back to the show.
Hi, Andy. Good to be back. Thanks for having me again.
I think it's our first catch up of 2026.
Yeah, I think it is. Yeah, it's been a crazy beginning of the year.
It has. And we're
Mm,
kind of storming towards the end of Q1 already, which
I
is
know.
feels pretty crazy. And I feel like there's a lot of stuff to talk about. And I feel like it's the first time in a while that I feel like we might be able to have quite a positive conversation. I think things have been gradually improving. We've talked about that. We've talked about the data. But it feels like there's been a definite uptick on a number of things today. So I'm quite excited about having this conversation. I mean, before we get there, Ellie, I was doing a little bit of research just on house price data, on lettings. Just wanted to kind of really bring myself up to speed on exactly where we are. So I think what I'll do,
Mm.
first of all, is just share a little bit of that just to paint the scene of the market currently. So I went back and looked at a few different sources. You never quite know who to look at, and they're very rarely exactly the same. But if you take Rightmove House Price Index, for example, from January, average UK asking prices are up to about 368,000, up 2.8% month on month from December, apparently, which sounds a lot to me. But perhaps more importantly, a 0.5% year on year increase. So, not quite sure how that's working, but I mean, my interpretation of that is not a huge change. Halifax are reporting a 0.7 month on month increase to January 26, with annual growth year on year of 1%. So, I mean, look, if you took a line somewhere in the middle there, the answer, or the result rather, is that there isn't a huge amount. There hasn't been a huge amount happening in terms of
No.
house price data. And I think the other thing that's important here is that might suggest growth, but then actually we know that inflation has been, just bumbling along, and it has
Absolutely.
certainly been higher than that. And we're
Yeah,
going to talk
it's
about
been.
that today. But
Yeah,
so
yeah.
real time, I think house prices are actually still, my interpretation is house prices are still actually down year on year.
Yeah. I think you're always going to get little bumps up and down. And December, we had a slow December because we had the budget in November and then everything kind of slowed down towards the end of the year quite quickly. And then we've had a really bright start to the year in January. So I think that's kind of more reflective of there's more people buying houses in January than there is in December rather than the
Yeah.
actual
And
growth.
you're absolutely right. We know
Yeah.
that this data lags a little bit, so we should take this with a pinch of salt. I would hope that, give this a couple of months, that data does start to look a little bit better. I mean, Rick's, they're kind of saying that sentiment is up ever so slightly as well, so not a huge change, but certainly nothing concerning. A question for you, Elliot. I just wanted to get a bit of insight, I suppose, from your perspective in terms of the amount of business, the number of mortgages being approved at the minute, the sort of activity that you're seeing. Do you feel like that what you're seeing kind of fits with those sorts of reports? Are you seeing something different?
Yeah, I think it is. Last year was very strange because we had the stamp duty change in April, and then we had the budget towards the end of the year. And I think those two things changed the way that mortgage approvals sort of worked throughout the year and the way that completions worked throughout the year. So I think comparing year on year this year to last year is going to be a bit odd because we had a really busy Q1 and then it slowed down towards the summer and then it picked up again and then it slowed down again towards the end of the year, more so than I've seen in previous years. So I think it will seem a little bit weird, but this year has started really well. We've had a really busy January and February. It picked up like almost instantly after New Year. I think everyone's really keen to get started. The end of last year was quite slow. And I think by the time we got to the budget, there was only 3 or 4 weeks before Christmas. And I think a lot of investors thought, you know what, I'm just going to have a chill and come back to this in January. And then, yeah, it's been really busy. We've had loads of like refinance applications, people trying to raise money to buy more properties, which is always really positive. And then obviously there's purchases as well. So yeah, it's been good. The approval numbers are up, rates came down. Shawbrook reduced their rates quite aggressively in January. So like nearly 0.5% off a lot of their rates. And then they've reduced their commercial rates. And I think that's a really positive sign because it means they want more business and they've got the capacity for more business. And they are like the big player within the specialist space. And also they don't change their rates very often. So when they do, it's quite significant. Whereas you've got
Mm.
someone like Lambay on the other end of the spectrum that are up and down like a yo-yo, but they reduced their rates quite considerably. And actually last week there was a few upward pricings, only slightly. We're probably talking 0.05, like a small amount. But that to me says they've got enough business in for now. That's like a
Mm.
slight change to try and bring them down, the rankings of rate when people are sourcing properties, so sourcing mortgages.
Well, I definitely want to talk to you a little bit more about what lenders are currently doing in the market at the
Mm,
minute, based on inflation data, based on interest rates and things like that. But what it sounds like, from what you're saying, you're obviously trekking ahead of the curve. House price data, we know it lags. You're
yeah,
seeing what's happening. You're at the coalface right now. So that activity, that kind of report from you, I suspect we'll probably start to see wash through in the next few months in terms of house price data.
totally.
Let's talk about just the lettings market then for a second as well. I had another look at this. I suppose anecdotally, I think it'd probably be fair to say that we can see and hear that it's taking a little bit longer to fill rooms. Maybe they're not quite
No,
getting the top rents that they were before. And I've certainly noticed this in my portfolio as well. So it felt like the lettings market, was cooling down for sure. So I looked at some of the data for this. And interestingly, if, for example, you looked at the ONS's private rental index and looked at it, I suppose, for the 12 months to January, UK rents were up 3.5% year on year. Now, what's really interesting is actually if you look at the December report, in December, they were up 4% year on year. So what that's actually telling us is that heat is definitely coming out of the market. There's been a
yeah,
0.5% drop from December to January. And I think that, that is definitely something that we're seeing and hearing from the community as well. I think it's something to be mindful of as well. I think we've definitely seen the peak growth of rents, that kind of real acceleration we had for a few years, and the heat has
I agree.
definitely come out of the market a little bit now. Again, depending on where you get your data from, these results vary a little bit, but generally speaking, the lettings market has cooled a bit. And I think everyone listening with rooms that might be coming up for filling soon just need to pay attention to that, because it can be really, really sensitive if you're not keeping an eye on that. Just because you got the
Totally.
top rent last time, or just
Yeah,
because you filled it in a week last time, doesn't mean that that's going to happen this time. So
no,
just be aware. Um,
totally.
any evidence, I suppose, from your side, Ellie? Obviously, when valuers are coming to look, are they paying attention to any of this? Has it done enough to actually cause any real issues when people have been coming to either refinance or finance something? Any thoughts on that?
It doesn't really make that much difference. 'Cause I think there's a belief with a lot of investors that if they've got a room filled, like a property filled with all those top end rental figures, particularly if it's a brand new conversion, then the valuer is going to use those rental figures, which it doesn't normally happen like that. The valuer will use market rent. So in which case, I'm not seeing it make a difference because we'll always work off market rent, and that's what I use in my calculations to kind of give clients an estimate of where we're heading. So
Sure.
no, I don't think it does. The only thing that is causing a slight issue is that lenders like to have the properties filled on completion, unless you've got a sort of big enough portfolio that you can absorb any gaps that you've got there. So what I normally say to people is, let's have the property valued as soon as the works are finished, if it's a new conversion. And then in the time between having that valuation carried out and completion, that's when you want to fill your rooms. And that process is taking a bit longer than we would normally see. So that's the thing I suppose to be careful of. You just, like you say, you need to be organised with it all. So can you get some drawings done? Can you get some, mock-ups? Can you use other properties that you've got that look in a similar condition and try and advertise those rooms prior to the house being ready? Just really being on the front foot. I think it's more important than ever.
Yeah, I think that is really good advice, actually. And it's also worth remembering that when we're seeing this sort of data and we're hearing these sorts of things, there can be almost a compounding effect to it, because if a few people start to struggle with rent in a location, then actually very quickly tenants can see that and they start shopping around. They
Totally.
feel like they can negotiate, they can push things a little bit. They
Yeah,
feel less urgency to move, perhaps because there's more opportunity in the market, there's more rooms available. So something to be aware of, because on a regional level, this can be quite different as well. I think some
yeah,
areas are still incredibly buoyant, probably able to still push your rents, but I think in some areas, this is more a problem than others. And just
yeah,
remember, guys, that this data, this is average data. It's not necessarily where you are or where your properties are. It could
yeah.
be better, it could be slightly worse. So just be mindful of that.
I think also like longer term, sorry to interrupt, just if thinking if you where we've had the last couple of years, investors thinking that they can really push the number of bedrooms that they've got and really kind of go to those minimum room sizes, perhaps take away an ensuite or two, just really pushing the number of rooms that they can put into a property. Actually, if you've got more tenants in smaller properties, you're more likely to get a turnover of those tenants. So I think longer term, if this is how we're going to be now for the next however many years, if you're doing conversions now, I personally would do larger rooms and less of them, because I think if you've got less turnover of tenants, you will have less problems long
I
term.
I completely agree, and I think on, the backdrop of the new legislation coming in and how clear it is to us as landlords now that we should be much more focused on making sure our tenants are happy and stay
Yeah,
and pay. I think that that is more important than ever. We know that people who value their accommodation are much less likely to stay. If there is a reason or we give them a reason to move, then there's a good chance that the smallest thing might just push them, to actually
totally.
make that decision to move. And then ultimately it comes at a cost to us. But more generous rooms, better amenities, not squeezing everything out of the property. I think that it's more important now than ever to look beyond the spreadsheet, which is, remember,
Yeah,
only the interpretation of what that deal looks like today, and think more about the 10, 15, 20-year life cycle of that property. And I do agree with you. I think better amenities and focusing on that more than we perhaps have had to in recent years is
yeah,
definitely something we should be doing.
I agree.
Let's talk about interest rates then. So February's MPC meeting. Obviously, it was a pretty tight vote. The held rates are 3.75. It was a 5-4 vote. But give us your sort of breakdown of this, Ellie. What does it mean? What do you think it looks like for the next meeting? And how has the market reacted?
So the market kind of reacted before, like previously, before we had the reduction down to 3.75. And then I don't think we've seen any kind of market led reduction. When I speak to lenders about where they have had rate reductions, it's been more around, wanting more business through the door and having access to cheaper funding from more mainstream banks, things like that. So I don't think we've really seen it as yet. There's been a little bit of a bubble up and down, but you always get that bubble up and down based on volumes and, how much business people want. So I don't think we've really seen it. And I don't think that we're quite, the next meeting will be in March. So I don't think we've seen kind of the pricing coming into, an assumption that the rate is going to go down, for example. I don't think we've seen that yet. Prior to this month's meeting, there wasn't really much talk about another rate reduction until sort of May, June time. But then it has been really close, as you say, 5 votes to 4. So it'll be interesting to see what happens in March. I think the general feeling is that we won't see another rate reduction. But having said that, since this meeting, we've had inflation figures come down. They come down to 3%. Growth is still not doing a great deal. Unemployment is still up. So we do need to do something, the government need to do something to try and ease things to try and encourage spending. That's what we've got to do. And the easiest way, obviously, to do that is to reduce rates. So I think it would be interesting to see. It would be great to see another rate reduction, I think, from an economic point of view, as well as obviously mortgage rate point of view. But yeah, we'll see.
Definitely. I think seeing rates come down to the mid threes would feel like we're very much sort of on the way back to a better and more tenable lending environment. And I'm going to stick my neck out and, I'm going to say I'd be shocked based on the data that's come out, in the last couple of weeks if we didn't see a reduction at the next meeting. So I'm all in. I'm putting my chips on the table, Ellie, and I'm
Well,
going to
only
say
one person needs to change their mind, don't they? And then we've got a split like the other way. So yeah, I mean, yeah, it would be great. You know me, I'm a bit cautious with these things. So wait and see what happens. But yeah, I think it would be great. The thing is that, as always with these things, we talk ourselves into good things and we talk ourselves into bad things, don't we? In terms of like growth or recession, all these sorts of things. If we can talk ourselves into some economic growth, I think that would be brilliant. And at a 3.5% base rate, brilliant. We haven't seen that in years. And then also, it just sounds more positive, doesn't it? It's just everything sounds more positive. AIPs, I think, are up. It's been a really busy first couple of months for everyone that I've spoken to, every lender that I've spoken to. So if we can try and keep on that trajectory, that would be great. And I think investors would be far more likely to purchase new properties if you can see that the base rate is sitting at 3.5. So yeah,
yeah. Well,
fingers
it sounds like you're saying all the right stuff. I think the data that's come out recently is all pointing in the right direction. And I agree completely. Sentiment is so much about what actually happens, the tangible stuff that we see in the market, the fact that people don't go out and buy, they stop spending, they stop investing. So
Yeah.
I'm feeling positive. But I do want to say to our listeners that if you've been sitting on the fence, waiting for this to happen, waiting for things to start looking more positive, just remember what that means is the best buying opportunities might be getting
Yeah.
sucked up. They might be behind us. As things start to improve, there's a bit more scope in the market. There's more lending available. Appetite is stronger, better. There's going to be more competition for deals as people come back into the
Yeah.
market. And I do think if
Totally.
we look back a few years, there hasn't been much positive sentiment about property for quite some time now, and it feels like we are definitely due almost a bit of a revival of the opinion of property.
Although it's interesting because on the face of it, we have had no problems with valuations. I know we have this whole discussion, don't we, about down valuations. I hate the word down valuations. It is 99% of the time a mismatch between the client's expectations and how a valuer is valuing the property. That's where that disparity comes from. But from what I've seen, we haven't had a problem. Like the whole of last year, I could probably name you, I don't know, 2 or 3 valuations that we had that came in way off what the client was expecting. And yes, I know, I mean, we do a lot of work with clients around what to expect. So we're not just putting random numbers in and hoping for the best. We do a lot of work on that. But yeah, I'm not seeing commentary around from valuers saying that, things are looking terrible. It's just not, it's not happening. But it's a strange thing. But if you look at back to the statistics you were saying earlier on about asking prices in December were 10,000 less than they were in January, give or take.
Mm.
So actually December was a better time to purchase a property than it was in January.
It often is. It often
Yeah.
is. Okay, well, I think, my read into all of this is quite positive, and I'm usually pretty reserved about this stuff, but I'm going to stick my neck out and say that 3.5% is on for the next
Yeah.
MPC
It's it's
meeting.
it's coming. It's definitely coming. Whether it will be this, next meeting or the meeting after that. But yeah, I
Yeah.
would agree.
I think we're going to see an uptick in house price activity over subsequent months. I think that'll take the first half of the year to really wash through and see anything meaningful. But yeah, I'm feeling much more positive. So just to clarify then, Ellie, even if lenders were thinking the same, they haven't done much yet. We haven't seen anybody really kind of change rates, do anything material that would actually help us as investors.
Well, Shawbrook, as I say, their
Other than
rates came
Shawbrook,
down
yes.
significantly in January, which is a really, really positive move. But yeah, nobody else has. And actually their competitors haven't followed suit yet. So we'll wait
Hmm.
and see.
Were they more expensive than their competitors anyway? Shawbrook tend to be a bit more pricey,
It
right?
depends on what you're comparing them to. I mean, I would compare them to other lenders like Hampshire Trust and Castle Trust.
Mm,
Kent Reliance have always been a little bit of an anomaly. They are cheaper.
mm,
But lenders that will allow you to choose your valuer, who will allow you an investment value on a 5 or 6 bed HMO, who are you in that market, they are generally there or thereabouts. If you start comparing them to more high street lenders, TMWs and things, then absolutely they're more expensive, but it's a completely different proposition. So it's like comparing apples and oranges, it doesn't really work. But yeah, they are lower. Castle Trust have actually got some lower rates at 65 and 70%. They've got some good sort of special edition products, but you've got rates in the fives at 75% with Shawbrook and Castle Trust. So
okay.
that's really positive.
Great. Okay. Well, let's move on from interest rates. We've touched on inflation. I don't think we need to labor on it, but the inflation data was better perhaps than expected as well. So
Yeah.
that trend seems to be moving in the right direction,
Yeah.
which is great news and supports everything that we're saying now. Let's have a chat about some of the other stuff that's kind of just washing around now. And I think that some of the news has probably brought this back to our attention. So let's just, for a second, Ellie, just touch on EPCs and the
Yes.
incentives, I suppose, from lenders, because we know that the government just moved the goalposts again. It's now, I
Yeah.
think, 2030. We've got to, achieve these certain standards. But I know that this is quite a focus for some lenders, and certainly there are some incentives if we are
Yeah.
hitting those Cs. So just tell us a little bit more about that, and how important is it for us to be thinking about this right now?
Well, I think the big thing is just taking advantage of what you've got, because what I've seen more recently is now, like you say, the government have moved the goalpost, and I think a lot of investors think, oh, well, I can't be bothered. I don't need to. I've got a valid one, a D or an E. I don't need a new EPC. But then you end up missing out on potentially lower rates or lower arrangement fees because of it. So I think it is important that investors are looking at it for a few reasons. So we've got a really good like refurbishment bridge product with a lender that will hugely reduce their interest rate if you are able to increase the EPC rating by 20 points and bring it up to a C. So that's during the refurbishment. So that's a real push. I mean, we can get rates of just over 8% on a bridge if you do that, which is really, really cheap.
Sorry, bridge lenders. Bridge
Yeah.
lenders are
Yeah,
incentivized.
yeah.
Why are they even bothered?
Well,
Maybe they're just very green-minded.
they are very green-minded, yes.
Okay.
Without naming names, it is a company that you'll have heard of, for not for bridging purposes, but yeah, they are very green-minded. They've got fingers in lots of different pies, and yeah, they're all very green-minded. So yeah, they're incentivizing you. So yeah, if you can bring the rate down to 8.4, I think it is, on a bridge, which is amazing. So that's a good incentive right at the beginning. And then in terms of like term mortgages, Shawbrook will reduce your arrangement fee by quite considerable amount with an A, less so for a B and a C, but still it's a discount. And that's the arrangement fee is added to your loan, and you're paying that for the whole time that you have that property. It's not just for your 5-year fixed or your 2-year fixed that you're taking out now. That's being added on forever. So if you can reduce that, it's great. That's a saving over the lifetime of owning that property. And then
Mm.
there are other lenders that have got reduced interest rates as well. So I think it does need to be a focus. It's relatively simple with a lot of properties to get them to a C. If you're not doing an extensive refurbishment, but a new build, A's and B's are kind of out of your reach a lot of the time. But all you need to do is hit that C, and then you are eligible for some good product. So I think
Mm.
it's something that just to be mindful of, keep it in the forefront of your mind.
Yeah, I think a lot of people, a lot of members in our community are not even going and getting an EPC done once they've done their refurb.
Exactly that. Yeah,
They're
yeah,
doing the work. They're probably going to qualify for a C,
yeah.
at least, but just are forgetting to send someone back in to do an EPC assessment. It
Totally.
doesn't cost much.
Yeah, I had exactly that the other day. Yeah, clients owned this property for 5 years. He did the refurbishment 5 years ago. Has got an EPC of an E. He's never bothered to get a new one. I'm sure he would get a C if he did, because he's done a lot of work on this property. But yeah, and he's going on a product that would give him a discount had he got that EPC. So I've spoken to him about it, and he's going to get that sorted. So it's just thinking about it. Yeah, keeping it at the forefront of your mind.
I'm not going to get on my soapbox today about this, but it does drive me mad. I've got blocks of flats, new homes, and they're all electric, and
Yeah,
it's so hard to get a C. Like
it's
nobody
so hard.
understands how difficult it is to get a
Yeah.
C at the minute. I think they are going to change it, and we're going to get in the near future penalised for gas boilers and probably better weighting towards electric.
That's the problem, isn't it? Electric boilers are more expensive to run, and EPCs were never designed as a green
No,
label. They were designed to know how much it was going to cost you to heat your home,
to run the
basically.
property.
Yeah. So they're a bit mismatched. A couple of years ago, I was at an event, and there was a lady there who works for something to do with the EPCs, and she was talking about, well, they're sort of recreating something, so it's moving towards net zero, and I think
It's
we
in the
will
pipe.
see
It's
that
in the
in
pipeline.
time.
There's
Yeah.
change.
Yeah.
It doesn't look good for boilers, though. That's the one thing I would say. So, right now, anyone listening who's buying a pretty standard construction property with gas central heating, it shouldn't be too difficult to get to a C at all. Maybe a bit more difficult on some of the very big properties, the big old Victorian homes and things like that. But generally speaking, a C should be pretty doable for most of us without having to spend that much. But yeah, the direction of travel is, just so everyone's aware, the scoring system will change, and it will be harder for gas centrally heated properties to achieve the same scores. It will be a bit easier for all electric because obviously that push to go green is kind of working its way through.
It does, yeah. I mean, it doesn't really make sense because, yes, it is a cost thing, but you can have 100% renewable electricity quite easily by choosing the right provider on your home, whereas gas obviously
Ugh.
can never be renewable, can it? So, yeah, it makes sense, and I think it will catch up in time, but it's difficult if you're trying to tick a box now for
It's so
something.
difficult,
Yeah.
and I think we've seen the goalposts move so many times already, and I've been quite vocal about this. Yeah, if someone's going to have to spend a lot of money to get to a certain target, is it worthwhile doing? Arguably,
It's
well, it
not.
hasn't been worth doing so far. It's going to happen, and I think that this is great advice to be sharing on the show. But if it's easy to do, please, make sure you are doing it, guys, listening in. And if you do need to spend a few quid, then really, I think you just have to weigh up your position. Think about what the investment's going to cost you, how long you plan to hold this property for. If it's a 10, 15, 20-year investment, then it's almost certainly going to make sense for you to make some investments that
Yeah.
give you that better sort of energy efficiency. Okay. So it's a weird one that we're talking about EPCs from a lender's perspective. I find it funny that they're so bothered about this. Like, I really can't understand. Maybe it's just a nice way to get more lending on their books.
I think it is, and I think it's part of like an overall strategy to try and make sure that the mortgages that they have on their books, if this ever changes,
Mm.
is moving towards that. It kind of takes out a problem. But I think I'm not sitting here saying, everyone should be striving for an A on their properties when they're doing their refurbishments. All I'm saying is just be mindful of it. Like, if you're doing the works anyway, engage with an EPC officer, find out what you need to do. Yeah, like you say, a lot of it is stuff that you'll be doing anyway. It's changing windows, it's insulating, it's LED lights. That's it, isn't it, really? If you do those three things, then you're going to up your rating quite considerably. And just make sure that if you are doing the works to it, don't sit there on an E just because it's legal and it's fine. Try and get a C and get a discount, because why not?
I like to remind people as well that you can go and do an online course to become an EPC assessor if you like.
I've got a client who's done that.
So if anyone listening today is going to go and do that and feels like scoring generously, then put me to the top of your list. Okay, cool. So that's
Yes.
EPCs. Now, Ellie, I know that there was something that you did want to talk about today very briefly, that has concerned you a little bit, and it's around the Article 4 stuff. So what's going on?
Article 4 has been driving me a bit crazy. I would say that all of last year, it's just become a problem. And I don't know whether it's become a problem because more people are now buying properties that were already HMOs in Article 4 areas, because I know you've got a lot of mentors and property education places that are trying to encourage people to go to Article 4. I think there's a lot of misconception around, you're more likely to get, well, maybe not quite misconception, but you are more likely to get an investment value in those places. There's a lot of cities now where it's more tricky to get planning, so therefore it's a safer way to invest in those areas. But what's frustrating about Article 4 is that no situation seems to be the same, and no lender seems to deal with it in the same way. So I've had examples where clients have refinanced. A good example in Brighton, so it's been Article 4 for over about 13, 14 years in Brighton. Clients owned this property since the 90s, and he had all the evidence. He's never got a certificate of lawful development, but we had enough evidence that we could provide to the solicitor. The solicitor was comfortable. We got it through. No problems. No indemnity insurance, no certificate of lawful development, absolutely fine. And then I've had other examples, one recently, where a client's trying to buy a property in Article 4 in Bath. So again, somewhere where it's more tricky to get planning in the centre of the city. And the lender said no, because there's not enough evidence to suggest that it has been used for a period of time. So it's just very difficult for me to say, yes, that will be fine, or no, that won't be fine, because I genuinely don't know. And I mean, planning has always been something that's kind of outside of the mortgage process, like that is dealt with by solicitors. I can obviously guide clients. I can say, if it's a definite no, I'm more than happy to speak to solicitors about things, and I do regularly to find out what their take will be. But it's really tricky. And I think that, investors just need to be really mindful of what they're going in for. And I think the big thing for me is around understanding, if you're buying a property for priced as an HMO, so potentially an investment value, but it's not got the right planning, should you be paying that money for that property? Because in effect, it is a house, isn't it? It's not an investment. It hasn't got the right planning usage. And that's where things just become a bit more difficult.
Well, I'm not going to sugarcoat it. I think anybody who is trying to buy something that doesn't have the sufficient evidence, I think it's just lack of complacency. I think we all know that, without the evidence, it may come into question. And of course, the first person who's going to question that. And I think the assumption is sometimes that, well, what's the likelihood that I'll get a planning enforcement? But it doesn't matter. It'll be a lender, either when you buy it or a lender when you come to refinance it. And if that solicitor working on behalf of the lender ask you for the evidence and you're not able to provide it, it's going to be a very big problem. So my opinion is that this is really black and white. We know what evidence we need. Ideally, we need every single tenancy agreement or a certificate of lawful development. And if we haven't got any of that, then we have to make sure that we're able to explain any years where there's missing data. Perhaps it was a year where it was out of cycle, it was being refurbished, whatever it might be. But I don't think we can cut corners with this stuff. And I think anyone who does really is kind of skating on ice, really, because I think that it's just a matter of time before someone sort of says, hang on a minute, where's your evidence?
Well, there's two things, I suppose, because there's one is a lot of people don't want to put in the application for the certificate of lawful development, because while you haven't got anything outstanding, you could potentially use indemnity insurance, or you can just prove it. You can just show that. If you put an application in and they say no, then you then can't use the property as an HMO. It's then illegal. So I can understand why people don't want to put that application in. But then the flip side, if you haven't got the correct planning, in writing, saying you're allowed to use it as an HMO, every time you refinance, or if you ever wanted to sell it, you're relying on a solicitor, probably a different solicitor to the ones that you've used before, being happy with the evidence that you've provided. And it only takes for one person to say, actually, no, I'm not happy with that. And the whole thing falls apart. So the safest thing is to have that CLD. That is the foolproof method. And I suppose I would encourage everyone, particularly purchasing a property, to have that in place before you purchase it, because there is always going to be a risk if you don't.
My opinion is a little bit different. I think in an ideal world we would have it, but often with the competitive nature of buying these sorts of properties, sometimes we have to just be prepared to move a
Oh,
bit more quickly
totally. Yeah.
and take a position
Yeah.
on that risk. Now, my position has always been, look, if I've got the evidence, I can see that this has been physically used continuously as a HMO, then I can take that evidence at some point and I can go and get my certificate of lawful development. But I don't necessarily need it today, and I can demonstrate that to solicitors, whomever. It is theoretically compliant. You, by virtue of having that evidence, you've got those grandfathered rights, but it is still a risk. I have worked with solicitors before who don't get it, and that's not completely, unreasonable, because it is quite a specialist field, planning. So, and their job is to report back to the lender, and, just one email with a
And
couple of
this is it.
lines,
Yeah.
is a
But
problem.
they're reporting to the lender. They're not acting for you,
Correct.
and they're not saying, well, it'll probably be okay. That's not enough, is it? So, yeah, where I've seen it be a problem is where the solicitors have said, I don't feel that this is enough information. And like you say, when you have had gaps, like if you've had a refurbishment, out of cycle, whatever it is, that then adds more, uncertainty to whether you would in fact get that certificate of lawful development. So yeah, it's a tricky one. But I think you just need to go in with your eyes wide open. And just the big thing to remember is that just because a property's had a license for God knows how long, does not mean that it's got
No,
the
it doesn't.
correct planning.
No, it doesn't. A great reminder. And so make sure, guys, you've got your evidence. A HMO license is not evidence. And, if you choose to purchase a property without those documents at hand, then, it's buyer beware, and it might come back and bite
Yeah.
you later on. Ellie, I think that my takeaway today is that things are looking positive. I'm feeling quite good about 2026. I think as a buyer, as an investor, this is a good opportunity to continue to find good deals, to feel a bit more confident about the market. I think things are definitely a bit more predictable at the minute. Obviously, we can't have contingencies for black swan events, that may or may not happen around the world, and that still seems to be an ongoing struggle. But
Absolutely.
based on the sales and lettings data, based on the, I suppose, last MPC meeting, based on inflation, based on your anecdotal evidence, it's all feeling a little bit more positive.
It definitely
I
is.
think
It
it's a
definitely
great,
is.
great way to be going into Q2 2026.
I agree. I think there are plenty of opportunities out there. I think, and especially now, I think it works both ways, doesn't it? Because if people considering selling their house think that things might go quickly and they might get a good sale price, then they're more likely to put the house on the market. So yeah, the whole thing will snowball. Hopefully,
Well,
we'll have a good year.
this has been quite a refreshing conversation, because it feels like it's been quite a while since we've kind of been able to finish on that note. So for everybody listening today, if you are buying HMO, if you are refinancing a HMO, head on over to the hmoroadmap.co.uk. There's a section for specialist mortgages and finance, and you can leave an inquiry with Ellie. Ellie will be happy to have a conversation with you and sort out whatever your lending requirements are. But Ellie, it's been an absolute pleasure, as always. Thank you for sharing your insights, all of your
And you.
advice and knowledge with us.
Thanks, Andy.
Thanks, Ellie.